So thank you. My name is Kevin Stokes, and it's my pleasure to be the moderator of the reinsurance panel discussion. As we have mentioned previously, Guy Carpenter has had the privilege of producing for FEMA a report that lays a foundation for the reinsurance possibilities for risks in the NFIP. The fact that this study has been completed and is in the public domain is a huge milestone. In my over 30 years in the business, I never thought we would have a program like this where so many stakeholders are interested in an emerging market for the peril of flood. And so, we consider it a privilege to be hosting this inaugural event. We are all sharing so much good information and visions for the future, and it is hoped the conversations will continue outside this room. This panel of experts is designed to tell us what the appetite is in the reinsurance community to reinsure flood and, overall, how we should think about the risk flood poses. It is hoped at the conclusion of this panel that you, who own risk-bearing entities, will have a clearer picture of where the reinsurance community is on this peril. Now let me introduce our panelists. Immediately to my left is Keene Driscoll, the Chief Executive Officer of Validus Reinsurance Limited, the reinsurance segment of Validus Group. In the middle is Justin O'Keefe, Senior Vice President and Chief Underwriting Officer for Property for Renaissance Re Holdings. And on the far end is Tim Brockett. He is a Senior Vice President, Strategic Products Manager for Munich Reinsurance America. So before we get into the questions themselves, let's do something kind of as an icebreaker, if you will, something that's used in debate forums where we'll ask each of our panelists to take 30 seconds to say something nice about the other two panelists. No, hang on a second. On a second thought, let's not do that. We don't want to use all our time waiting for these guys to fabricate nice things about each other. But seriously, I had the benefit of we have the benefit as reinsurance brokers being in the soft market and being able to take a jab at our reinsurers like that. Things will change, and on a serious note, it would take a while to say very nice things about these fellows. So, with that, the questions are going to quickly go from a macro level to, meaning the world, to the U.S., and then move more specifically and direct the questions to Florida. So each of our panelists brings deep expertise in underwriting flood. For the benefit of our audience, will you please provide a brief background on your company's experience with underwriting flood around the world? I'd ask Justin to kick us off on that.
Thanks, Kevin. And just before I get in, just wanted to thank Senator Brandes for pulling this together. We had a couple minutes to spend last night after dinner, and as Commissioner McCarty said, this guy has passion. He's battling uphill, and you're doing a good job, so thanks for that and putting this together. Many of you know RenRe formed after Hurricane Andrew hit Florida in '92, and since that we've tried to evolve capital matching with risk. And where we currently sit in the global reinsurance marketplace is there's an abundance of capital and a scarcity of risk. And so we have spent a lot of time in the past decade trying to source new sources of risk globally, and a big component of that actually has been flood. We talked about Thailand, most recently actually a storm just this past week, Storm Desmond in the UK, Northern England and Scotland. I actually just saw some claims come through our claim system this morning. Flood is insurable. We have tools, we have capability, and more importantly, we have the capacity and appetite to ride it. Again, RenRe's built tools for years for it. What we've been waiting for is an appetite in kind of the primary marketplace to get over the hurdle of flood as an uninsurable risk. That's absolutely a falsity, and as we'll talk about later today, it's insured, broadly speaking, globally.
So in the U.S., you also have experience with writing flood on an excess basis?
We have experience with writing flood on an excess basis. We have
Primarily.
experience with working with MGAs, formulating tools and systems, even on their write your own programs, yes.
Okay. Tim, could you give us an overview of your company?
Sure, yep. So our efforts on flood, they go back quite a ways as well, but I think the serious attention to flood came in 2012 after Biggert Waters. and a cross-functional team was set up between underwriting and claims and affiliates with the Hartford Steam Boiler and American Modern, as well as geoscientists and underwriters around the globe to analyze what the opportunities in the U.S. might be with regard to flood. And you know, we kicked around a lot of concepts, most of them geared around your traditional reinsurance type opportunities. You know, is it reinsuring the NFIP? Is it helping our clients with a product and then reinsuring that on the back end on the treaty basis? We've come up with a couple really neat solutions. One we'll probably talk about a little bit later is you know, an endorsement that we're working on to be offered on a private label basis. But you know, as we've kind of gone, we've recognized that the market opportunity, as Justin said, is right here. As previous speakers said, also the data, the technology is here as well. And we've actually devoted resource to the peril of flood, and my title is, I'm in charge of the strategic products unit, but right now it's the strategic product, which is really 90% dedicated to flood. But you know, globally, Kevin, I mean, it's, you know, we have a team of 40 geoscientists that have been involved in analyzing the flood peril around the world, been involved in public-private partnerships, reinsurance flood that way, done it on a primary basis, done it on excess loss basis, and have insured and reinsured flood successfully on the commercial lines side of the business for years.
Thank you. Keen, how about Validus?
Yeah, I think quite similar comments. We started our organization at the end of 2005, and our origins are from the capital crunch that originated from the series of events into the hurricanes in 2004 and 2005. And if you all recall, one of the major failings of the available vendor models was the performance in Katrina, and specifically the fact that the industry hadn't necessarily addressed flood and storm surge specifically. So to that end, when we formed our organization, one of our core ideals was to invest heavily in research science. So like Munich and like Ren, we've got a large dedicated team made up of geophysicists, hydrologists, statisticians, and recently we've partnered with a large write-your-own carrier. We spent 18 months developing a specific model designed to write private market risk, residential risk in the U.S. To compete directly with the NFIP. So that's recently launched. We recognize that there is data, there is technology. It is a very, very challenging process. We've invested heavily in it. We are very bullish about the prospects of expanding the private role in the public-private partnership that is NFIP. It should come through a variety of different channels. Right. We also write significant amounts of flood reinsurance, both on a primary and an excess basis globally.
So you have experience with excess flood for homeowners business?
We do. And I was also hoping maybe you'd give each of us 30 seconds to say something about you.
Let's skip that and get on to question 2.
Okay.
It seems like each of your companies has done a substantial work with understanding the peril of flood. We also heard in the earlier section that commercial vendors have recently made tremendous progress in developing U.S. flood models. In your opinion, Tim, what is the status of the flood models, and what are the challenges in understanding the 3 major types of flooding: storm surge, river flood, and hurricane-induced precipitation?
Mm-hmm. Well, I think that the flood models are fantastic. I mean, we've done a vetting of, I would say, 4 different inland flood models, you know, both within my team and globally. And the science that's behind that is sound. It's solid. You know, it's a model at the end of the day. You know, I think you know, we've asked some questions around, you know, how did the model do in Texas? How did the model do in South Carolina? Like any model, it's going to get some right, some wrong. But it's a data point, and it's on a portfolio basis. We really do like the science. It's you know, I think it's the underpinning of what any company should be trying to do from a private market standpoint is A, understand that model, and B, develop your own view of risk around that model, and go forward with with the model on that basis. I think there's no shortcutting the model validation process. You really do have to kind of go back. The NFIP data is going to help, but there's holes in that, and so you have to go back on your own, look at some other data sets, and backfill, what might have been the hurricane-induced precipitation piece of a certain, a certain flood loss, and get to within a margin of error in terms of your own view of risk.
Keen, what's your take on the models?
Why don't I, having gone through the process recently and then gone through a fairly rigorous validation process, and we chose ultimately to build our own models for a variety of reasons, and so I'll just highlight where we think the potential pitfalls may lie. I do think the models themselves are, the available commercial vendor models are an excellent start, but if we look at where some of the improvements need to be made over time, or where we've made adjustments to our own model, first, I would start with frequency adjustments in the model, and particularly related to storm surge. We saw that in the Northeast with Sandy and Irene in the prior years. I think some of the frequency in some of the areas is off, so you need to be very conscious about frequency, either at lower intensity storms or even at some of the more higher intensity storms. The storm surge models themselves, I think, or we think, should be numerical models. Some of them are statistical. Some of them are overly simplified in terms of the methodology they use for storm surge. And so there needs to be a real granular view on topography and elevation to account for some of those factors. Beyond that, there are certain non-standard exposure characteristics beyond elevation that are influential in terms of driving expected loss, and we've sourced external data, we validated that process. They're very influential in the risk selection process. So I think the bones are there, but there are some nuances that need to be understood and accounted for before people plow headlong into relying on the models.
Good, thank you. We heard in the previous section regarding the FEMA rate adequacy or inadequacy in many areas, and where the potential business opportunities or dislocations might lie. In your opinion, Justin, what do you think are the real business opportunities for flood in Florida?
Yeah, I think we're sitting here literally from a geographic perspective. So if you think globally, you think the United States and the NFIP, the way I like to look at it is where's the low-hanging fruit and where do we start as an industry kind of writing flood? It's actually here in Florida. And some of the numbers like Guy Carpenter presented earlier, the average annual losses or expected losses, I'm not going to say I agree or disagree with the actual numbers there, but what's very clear is a huge portion of the NFIP expected loss comes from Florida. A huge portion of that loss comes from hurricane-related storm surge. That's something that those of us sitting up here on this panel are very comfortable taking, very comfortable analyzing, very comfortable taking from a risk perspective, very comfortable talking to our capital providers about that risk being essentially hurricane, whether that's inland flooding from hurricane or that's actually simply surge in the state. So the way I think about it is starting on the low-hanging fruit, and the good news is that's here.
Thank you. Keen, are there any studies that you'd like to see performed to help you evaluate these opportunities?
I'm not sure studies. I think there are legislative changes that we'd like to see. I don't know if I'm jumping ahead of on a question for you, but there's clearly areas where there's uncertainty or silence on certain issues that inhibit private market involvement. I think what Representative Ross with the Ross-Murphy bill is working towards is a fantastic outcome. We need to address the grandfathering issue to allow both agents and consumers to have the assurance that they can try out the private market and still have continuity within the existing rating plan. We need to ensure that both E&S and admitted markets can compete effectively. Senator Brandis and I had this discussion last night, but, I'm of the view that the NFIP, the fact that it exists, it is really the only market right now. That in and of itself is an appropriate governor on competition in the marketplace. And so I think if we can get some clarity that allows the mortgage service providers to utilize private market solutions such that they can sell the mortgages onto the GSEs, these are all things that are clearly beneficial in stimulating private market demand.
Good, thank you. You mentioned agents. Tim, do you have any thoughts on how to incentivize the agent distribution and customer side of the equation to put more business in the onto private company balance sheets?
Yeah, it's a tough question. It's I think the simple answer is education. It's helping agents educate policyholders such that they understand that the value of insurance is better in the long run, not just to them but to the economy overall than federal disaster aid. It's education on the front of helping the agent and the policyholder understand the difference between sewer drain backup and flood. There's still a lot of confusion, at least on the policyholder side, when the sewer drain backs up, if it's a flood, that they don't understand that they don't have coverage. So education efforts would, I think, help incentivize agents. Also, making it easy to do business. If it's complicated, if it's hard, if it's extra clicks, if it's extra work, it's going to be less easy to sell the coverage.
Okay. So let's now talk about reinsurance capacity. Historically, reinsurance capacity has been deployed for excess flood in the U.S. homeowners market. Justin, can you comment on the current reinsurance appetite for primary flood in the U.S. and specifically for Florida? You may have touched on some of these things when we talked about the opportunity, but...
Yeah, I guess I've touched on this a couple times. Maybe better off just kind of talking about a story. So Keene was talking about the crunch of capacity post-Katrina with all the flooding that occurred. And I remember sitting in Bermuda in Renaissance Re offices, and there were about 5 of us sitting around a table deciding what are we going to do and what's the market need. And we decided we want to grow risk. We have capital that's willing to support this. We have tools to underwrite it. The industry, because we were all taught in CPCU number 2 or whatever it was, that flood's uninsurable. Let's go to our treaty exclusions and take out the flood is written as such exclusion. So that was our idea, kind of November of 2005. And we said, well, before we go, send it to Britt and Tim in the world to go sell it and give it to the clients so the clients can all write flood, we better call a couple of our big clients. And the interesting feedback we got at the time, this is maybe naive, a couple of us sitting on a little island in Bermuda, was a couple of big primary insurers in the United States that we called said, don't do that. We don't want flood. We can't insure it. We're happy to give it to the government. And I think the fact, if we just kind of sit back and observe where we are today versus that 10 years ago, we're in a position to have these conversations that we weren't able to have before. And the capacity from a reinsurance standpoint, I certainly speak for myself, and I think Keene and Tim would agree that there's plenty of capacity and ability for the reinsurance marketplace and or insurance marketplace to take the risk, and there's tools to look at it. It's really the political environment and some of just the good old nature insurance, U.S. insurance professional getting over the hump that, hey, we can insure flood. And I'll leave it up to the primary insurance folks in the room to figure out from an agency distribution and policy form, et cetera, and working with the commissioners of all the states to figure out the right way to handle it in the system.
Right. So just to echo what you said, there's definitely increased interest on reinsurers to
absolutely. We've put in
flood.
millions of dollars just recently within our Weather Predict consulting group here in the U.S. on building out our own proprietary storm surge and inland flood models.
Okay. Do you currently have enough of a comfort level with the flood peril insofar as historical data and modeling capability to offer primary flood capacity? Keene, would you like to address that one first?
Yeah, I mean, we've got a product offering out in the marketplace right now. We're offering expanded coverage at reduced rates relative to the NFIP for policies that we've identified to be quality risks. Now, not everything in the NFIP is a great risk, but undoubtedly we look at the universe of policies and opportunities, and whether from a primary perspective or from a reinsurance perspective, we're interested in expanding the pie, in creating and stimulating demand and trying to leverage our analytical capability and our ability to source capital, whether it's on our own balance sheet or we do a lot of third-party capital management, matching capital, matching analytics, and matching appetite, and trying to stimulate demand. So unquestionably, we have a strong appetite and interest in flood risk, particularly in the U.S.
Okay. So simply put, Tim, Florida is insurable. Would you agree?
I would agree. I would agree. Yeah. I mean, I think that's, Keene was spot on there in terms of, expanding the pie. There's issues, on the coast and correlation as a reinsurer with our in-force wind budgets, and we have to work out, how we would, how more flood would impact what we already have on the books, but there's opportunity there. We look at the Zone X, where that's judgment rates, from the NFIP standpoint, and this is ground zero in terms of the $250 surcharge. There's real opportunity for a private market to come in and do good things.
Okay, great, thank you. Historically, we have observed that as capacity for cat perils evolves over time, reinsurance product innovation goes through cycles. In other words, pro rata might be the dominant reinsurance play at the beginning in order to piggyback on reinsurers' knowledge for a particular risk and/or capital reasons, and then, generally speaking, it shifts over time towards the excess of loss product line as knowledge and experience is gained and the overall market matures. Justin, given where we are in the reinsurance cycle with the huge influx of convergence capital, what type of reinsurance product innovation do you foresee in the flood space?
I should just note I'm representing our U.S. company right now, not Bermuda, just for tax purposes. Talking about reinsurance structure here. I think the evolution of pro rata excess probably makes sense. So I think we'll see some of that in the marketplace as carriers want to work with the reinsurer more closely. That lends itself to pro rata, and over time look at excess. Tim had mentioned just briefly the correlation, which we haven't touched on here. The correlation with wind risk and surge risk is real. That's the point. The uncertainty around flood modeling, surge modeling, I believe is higher than we have, certainly in our view, with hurricane wind damage. And so when you're adding that component to the wind damage, to your wind PMLs, if you will, you are adding more uncertainty into your risk distribution. And I think for this group in this room, it's really important to understand that. I'm not saying flood is for everyone, writing surge is for everyone, for every insurance carrier, because you really need to understand the additional risk that you're bringing in the system and then how you're seeding that out to a reinsurance partner. But I'm sure there's going to be, an evolution of product and design about how that happens. We've seen it already in recent times within just the flood space.
Okay. Keene, how will different capital sources, traditional ILS, et cetera, play a part in reinsuring flood risks?
I suspect it'll follow a similar pattern to what we've seen with other risks, where traditional reinsurers in this aligned model tend to be the predominant repository for new capital coming in. It's sometimes it goes into independence, sometimes it goes into aligned models. Munich, Renaissance, and Validus are all leaders in that space, but it's a new peril, relatively speaking, and so I think you'll see it come in through a traditional reinsurance solution, a rated reinsurance solution, and then you'll find capital that sits behind a reinsurance company that then allows you to leverage your balance sheet. And I'm sure they'll, as that natural evolution from proportional to excess, we'll start to see more direct engagement with the ILS market, whether it be through cap-on vehicles or aggregate solutions, fully collateralized aggregate solutions.
Okay. Speaking with a number of primary carriers about flood insurance, it seems there are maybe two basic categories that they fall into. One, the deep dive client who wants to understand the modeling and science behind flood. And once they have this knowledge base, they look for reinsurance capacity. And two, the client who wants speed to market and looks to borrow a reinsurer's balance sheet now for the flood peril. And as they gain experience and knowledge, they will look to potentially take some of the risk back onto their own balance sheet over time. So Tim, if we accept these two categories, what kind of services beyond just capacity are you able to provide to advance primary flood in Florida?
Well, I think, I mentioned our affiliate, Hartford Steam Boiler, in the past, earlier in the conversation in terms of the white label approach and in a sense, essentially, coming up with a form and pricing and the IT and the accounting workflows and basically, placing a client that's maybe less comfortable with flood capacity into the flood business with their stamp on the endorsement is a possible way to go. I think, in terms of the back end support, I think that would have to be there long term. I mean, you can't, as a reinsurer, we're used to kind of moving in and out if we want to, but we would have to write some sort of a kind of a longer term contract over that sort of thing. But the white label approach to flood, I think certainly could work.
Justin, can you comment on any services that RE can provide?
Yeah, I guess the way I think about it, so the broad brush, so you have the deep dive and the client that wants it all. We would be much more apt to partner with someone that has a view of the risk themselves in a reasonable kind of conservative fashion, especially when getting in a new peril. Being approached by someone that essentially just wants to be an agent for the risk distribution and wants us to do all the pricing, modeling tools, accounting process. For us, we can do. We've had discussions with companies around the world on that. It hasn't fit as of yet. And part of the reason, and it's really, I think, applicable for the state of Florida, is that there are a lot of companies. There are a lot of companies that you find yourself competitors with. And as a reinsurer, you really want to watch out for putting a core company client in business to then compete with 10 of your other core company clients, and giving everyone the same pricing tools and same metrics. I mean, the reason we like flood and storm surge is because it's an inefficient market. There's a huge spread. You think about just a bid-ask spread right now in the marketplace. So Key may walk into something and say, I think it's 100, and I may walk into something and say it's 500 or vice versa. That creates opportunity for all of us in the marketplace. Because there are different views of risk and there's different models and different tools out there right now. So I think the broad brush for us, going broadly with one product to a broad group of companies won't fit. But I do think that we'll find our spots to write risk in the marketplace.
Okay, good. Keen, anything additional from your perspective?
We've always tried to create some differentiation, really from our earliest days in a syndicated marketplace, and we found that leveraging our analytics and pushing that product out to our customer base has been one way that we've had a lot of success in that. So when we look at what we're doing for ourselves in terms of our primary flood offering, there's a variety of potential services that we could include with reinsurance capacity, and our expectation is we're remunerated from the reinsurance transaction. We try to create stickiness around that by doing things like sharing high-resolution coastal flood maps or identifying exposure characteristics that help enhance rating tools, and Tim made reference to it, but rating tools for special flood hazard zones, so sort of the Zone X areas, portfolio level monitoring. So there's a variety of things that we do for ourselves that, from our perspective, working in partnership with our brokers, try to enhance the overall service offering to the customer base.
Okay. Being mindful of the time, we'll do one more question. We heard from Senator Brandes and the Commissioner regarding the regulatory push toward private flood insurance. What realistic regulatory strategy or legislative initiatives would you like to see in place that will have most positive impact on opening the flood insurance market? For example, regulation, more developed underwriting strategies, et cetera. Tim, what's your take on this?
Yeah, I mean, I guess this is a good place for the plug on, not plug, but the Munich Re view on the value of risk mitigation. Insurance, that's what we're here to talk about, but it's probably not the end-all and be-all, certainly in Florida. So, we would certainly, welcome all efforts within the state of Florida and across the country to improve mitigation. In terms of legislation, I mean, I think Florida doesn't fall into this category, but any states that advance the thought that we should have to take, insurance companies should have to take all comers and price to adequacy, impedes a private flood market. So we, as insurers and reinsurers, you'd prefer the ability to risk select. And then it's certainly, public-private partnerships. It doesn't really fall into the realm of regulation, but we certainly are willing to advance those conversations with our broker partners and move things along in that way.
Okay, I said that was the last question, but let me throw a question out to the insurance companies and ask, what is your biggest need today from the reinsurance community? If anyone wants to respond to that. What is your biggest need from reinsurers? All right, I'll take that you want to discuss it in private.
No, we're fulfilling all their needs already.
Which is fine. Actually, we do have, okay.
The biggest need that the industry has right now is the confidence in the insurance market on the loss models to use capacity. You're telling us that you're ready to do that.
I think they are.
That's been the obstacle since the beginning of the program in 1983 is no reinsurance. But now it's there.
Yeah, I'd agree with that.
Yeah.
As things are developing, models are.
That was the impediment.
Yeah, and spending a lot of time on flood over the past couple of years, one of the things I've observed is what I think is complex, most insurance companies do day in and day out and they think is easy. So you talk about the distribution of the product, the pricing, working with the OIR, the different departments, et cetera. What I think is easy, a lot of insurers tend to think is complex. And what I tend to think is easy is going to find hundreds of millions of dollars of capacity and pricing up big aggregate portfolios and putting capacity into the marketplace to support the risk. And so what we're seeing now, I think, is combining those two, because I do think one of the biggest impediments that we still have in this is how, when the rubber meets the road, how is the product really sold? The expense structure in the world that we live in today with technology going, especially in the personal lines marketplace, the expense structure around flood, dare I say it, there's too much E in the combined ratio right now. There's a lot of expense that needs to be cut all of it, I think, for the product to meet the final objection, which is to take a lot of that into the private marketplace. But, and again, I've been doing a lot of research on it, and I think the insurers across the country, specifically in Florida, really need to be thinking about new ways to distribute that product.
Thanks, Justin. And thanks, Keen and Tim. As I close this panel, I think we've learned 4 things. 1, that flood is insurable and reinsurable. 2, that having a conversation about primary flood is now a reality with leaders like Senator Brandeis, Commissioner McCarty, and many of you in this room. 3, the policyholders who need this coverage need choices and an understanding of the coverage's importance, and that, as they say, we are all in this together and we need to continue to work and collaborate on solutions. So let's give our panelists a round of applause.